Welcome back. It's a Thursday morning. Hope you're having a good start to the day. Well, we'll talk all things commodities, and to help us out with that, we have Peter McGuire, CEO at trading.com, who joins us. Hi, Peter. Good to see you this morning. Commodities seem to be perking up a little bit. Tell us, how are you feeling about the space? You know, there is this hope that China is going to stimulate its economy. However, if I look at the recent prints that are coming out, actually June is showing some kind of indication of an improvement in comparison to May. What are you working with in terms of a stimulus coming out of China?
Well, good morning, Nigel. I think, there's no doubt the second half we're going to expect to see significant firepower coming from China. We understand where it is from a stock market perspective and from property and the property overhang. The other side, of course, has got to be internal demand. We understand that we're fairly along the road. I don't know what the deal smells like or sounds like or looks like as far as tariffs with the US, but there seems to be, from President Trump's words, that they're making some significant headway. So that should be a fairly good sign for second half of the year. I'm looking forward to seeing Q3 bid up as far as industrial metals. And as you mentioned, the overall theme moving forward, the likes of platinum is up 40% in the last 8 weeks. So the market's certainly on fire.
That's right. Platinum overnight as well, I think, was up more than 5% or thereabouts. What about steel prices first? Let's address that. There was a news report yesterday that suggested that a couple of provinces in China are going to be told, you cut down production because that's what will support pricing. The pricing in China has been very, very weak. If I plot a last 18-month trajectory, pricing has corrected from what? $690 per ton to sub $500 per ton. Do you think bulk of the bad news is in the price? And as these sort of prices, well, they'll be forced to reduce production, which in turn will support steel pricing. Are you in that camp?
Yeah, I am in a lot of ways, as you highlighted, down, the best part of 30% in that window of time. So naturally, the only way to get prices up would be restrict production. And in turn, that might add to, a rising tide lifts all boats. So I'm thinking as industrial metals gain some traction, copper's over 10,000 a metric ton now, all of these metals could see a nice bump to the upside over Q3. So that's the general theme. Also, that sell-off as far as US dollar can't be discounted.
Yeah, that's working well for base metals, actually, the kind of weakness that we're seeing in the US dollar. But give us a couple of levels. Do you think that, global steel prices, give and take everything, demand, tariffs, China stimulus, would you be leaning to an uptrend from here on Chinese steel prices, which in fact, is a trend setter for the rest of the globe? Should we expect steel prices in China to move up, say, by 5 to 10% in the next 6 months?
Well, I think so. I think they'll nudge up because I think that 30% sell-off that you've seen is really going to say, it's bottomed out. There it gets a point in time, like all commodities, they get oversold and overbought, and possibly they're quite simply oversold at the moment. So I wouldn't be surprised to see a bump up. Let's see what happens naturally, the likes of some of those industrial metals as well. And the overall consumption, I think, you've only got to go to a city like Mumbai and see the steel production and steel consumption. So the world is certainly building and it requires steel, Nigel.
Yeah, indeed. And from an India market perspective, we used to do 110, 120 million tons 2-3 years ago, and now we're doing more than 150 million tons. At the similar time, the global steel production has not gone up, neither has demand moved up. And we know on a per capita consumption of steel, we're much lower than the global averages. So India clearly is standing out, and the center as well has done well to protect us from imports. Got that. So that's out of the way. Let's talk about gold, because no conversation is complete without gold. It's holding around the $3,300 per ounce. Where do you see that one headed? Is the bias to the upside, or you wouldn't rule out, say, a 10% pullback from here?
I think the bias is to the upside, a couple of things, because one, you've had that big sell-off as far as US dollar. You can't discount it. Secondly, the overall demand from central bank purchasing and, of course, retail land. The next part is, and from a store of wealth, the next part is interest rates and the Fed, what's happening if we get that non-farm payroll tonight and it's better than expected. I think that'll really put pressure on Fed Chair Powell as the tariffs come into play on the 9th of July. All of these factors, I think, is going to push gold higher. So I think the second half is going to be more dynamic than the first half. That's a big call, but I still believe that end of Q4 will be higher than where it is at the moment.
Peter, hi. Great listening into you, your call on all the metals out there. I just want to round it off with oil, because overnight we had this development of the Iranians saying that they don't want IAEA to come in and inspect, given what's happened. And then we're moving towards this meeting as well, right? OPEC, or is it OPEC Plus, the meeting that's happening a couple of days down the line. So for the oil markets, what are you watching, and what's the kind of immediate range?
Well, I think where it is, good morning, Surabhi. A couple of things. First off, you've seen it be pretty well, range bound. All the geopolitical noise and excitement has been drained out of the market. So I think it's going to hold these sort of levels. That's 64 for NYMEX, up to, say, 67, 68. I think it'll range trade unless you see something dramatic happen. There's talk as far as Iran. Well, this is... it's geopolitical talk. It's going to be very fascinating how this all develops, and it's only early in the storyline. So it doesn't surprise me, and I don't think it surprises many pundits at all. So we've just got to see what goes on over the rest of this month. But I think OPEC are going to significantly improve or increase their production, and there's going to be no shortage of oil.
Okay, so you're expecting, say, if we talk about Brent, you're expecting it to range between what? I mean, 65, 65, what's the range?
Mid-60s up to possibly a 69, 70 handle. But I think if they increase the production, I feel as though you're going to see, again, softness come across that crude complex. And that's, I think, the overall theme moving forward into Q3. I still believe there'll be a glut in the market by end of Q3, early Q4.
Okay, got it. So mid-60s to 70. I think we'll take that. We can handle that. Anything more than that is a problem for us here in India. But that's good to know. Thank you so much, Peter. You have a great rest of the day, and we look forward to connecting again soon. Thank you.
Thank you.